please help me welcome up our first panel of emerging managers, moderated by Barry Ritholtz.
All right. Welcome, everybody. We only have 30 minutes, so I want to get through a lot of questions, so I'm gonna keep my introduction brisk. I'm Barry Ritholtz. I'm the host of Masters in Business podcast on Bloomberg. Let's take 30 seconds and have each of you introduce yourself, starting with Michael.
Sure. Mike Alfaro, the CIO of Gallo Partners. We are an equity-focused energy and industrials fund that pays particular attention to regulatory and policy overhangs and how new laws and new regulations drive stock price and valuations.
Nadine?
Hi, I'm Nadine Buckland. I own a business called Zenzik Capital. We are a opportunistic real estate credit fund that focuses on the lower mid-market and mid-markets across the UK and Europe.
And Paul?
Hi, I'm Paul Podolsky. I'm the founder and the CIO of Kate Capital. We are a $1 billion discretionary global macro fund, so stocks, bonds, currencies, and commodities, long and short.
So let's start with you, Paul. I love founder stories. Tell us what made you decide, hey, it's time to launch my own fund.
The desire to keep growing as a person intellectually, and the desire to surround myself with people who wanted to be on the same journey. The first job I had out of college was being a foreign correspondent in Russia in the 90s. It had terrible pay, terrible food. It was dangerous, but I learned a lot. And that motivation has been what's guided me through my whole career. I'd worked at a big asset manager, Bridgewater, biggest hedge fund in the world for many years, and felt like this was the next logical step.
Nadine, you have an unusual background,
Yeah.
starting with your car. Tell us a little bit about your beginnings.
So I founded Zenzik 14 years ago. I didn't have an investment background before I founded the firm. I actually started off life in insolvency, working with companies that needed restructuring and refinancing in some way. In order to create an investment management business, I built a balance sheet business. So I started off life as Zenzik Partners, which was a corporate finance business that assisted borrowers trying to find the capital sources they needed in order to grow. During the early period, as Barry knows, I didn't have an office. I wanted to keep my balance sheet lean. So we drove around London in a car for the first couple of years, holding conference calls in the car. And then slowly but surely we grew into the business that we are now.
And Michael, tell us your starting out story.
Well, let's see. I started out at Zimmer Partners, which was an industrials and infrastructure-focused firm, and then was hired away by firm Covalis to run their U.S. business and global capital markets practice. And Covalis was based in Europe, and there was just so much travel back and forth. I really thought that there would be an interesting opportunity to launch on my own, especially what I saw going on in the early stages with some of the AI investments and what was happening with energy transformation. So reached out to some former Zimmer Partners investors, and they were interested in having me launch on my own, and started raising capital throughout 2023, which was a bit of a slog, but we launched in April 2024, and honestly grew the firm from just about 3 people to now about 10, and continuing to raise.
That seems like a pretty fast timeline, starting in 23 and
Yeah.
tapping out in 24. Did both of you have similar experiences from initial idea, or was it a little more gradual?
It was pretty fast. I left Bridgewater in 2020. We had a 3-year non-compete, so I sat that out, and then got the idea to at least talk with people if there'd be any interest. And we were fortunate enough to speak with an institutional investor. Literally, we just said, let's just workshop a deck. You'll tell us what's terrible about it, expecting that the list would be long. And but they said, well, here's some things you should fix, but we'd actually like to invest. And so I was like, oh, okay. Well, then that began to change things.
And Nadine, you spent the first dozen years really kind of retail oriented. Last year was your first year of institutional?
Yeah, absolutely. So The journey of the firm was that sort of 3 years into building that sort of more corporate finance-based business, we'd built enough balance sheet to start investing capital. We then invested our own money, and that teaches you a different way of thinking about investing capital for sure. The discipline that's required when it's your own money, I think, has held us in good stead for as we've grown as a group. We then moved into retail capital, raising a UK retail vehicle that allows us, it's permanent capital, so we can recycle that. That gave us a nice opportunity to build track record in the strategy that we're in. And then we moved into institutional capital. Last September, we launched an evergreen fund.
So let's talk a little bit about Edge and differentiation. How do you communicate the advantages of your funds to your either LPs or potential LPs? How do you set yourself aside from the crowd?
Sure. So during my time at Zimmer, it just demanded going incredibly deep on certain topics. And that was a little bit of the CIO there. You never knew what he was going to ask you, and you just had to be prepared for the gamut. And I think that's honestly carried over just to what I've done at Gallo Partners, where we like to go incredibly deep in the weeds on topics, because you never know what question is going to arise. You never know what's going to turn and maybe catch someone off guard. So I have this belief that you have to be an expert in your field, but when you're ultimately making an investment, you have to think like a generalist. So we spend an incredible amount of time on regulatory and policy matters, and that forces us in the range of spending huge amounts of time with the U.S. Fish and Wildlife, Department of Energy, Army Corps of Engineers, different government agencies that are truly making impacts on data center transmission being built, new transmission lines going up, pipelines going up, and that allows us to maybe better have an edge in understanding on project timelines, where there's demand, what's happening, and we've translated that into sort of where the puck is going and where the opportunity set is with the build out of AI, and we've had some good success with that.
Nadine, tell us about how you differentiate yourself from your competitors. How do you communicate your edge?
Sure. First thing to say is that we're operating in the UK and Europe in the low mid-market and mid-market. That's where there's been so little capital raised for that particular area of the market. And so what we like to do is fish in waters where the fish are fat, but there aren't many people fishing in those waters. And so from our perspective, how we're explaining our edge is to say that it's two or threefold. First thing is to say that, of course, where there's opportunity and scarcity of capital, you can really create alpha in those scenarios. So that's sort of one thing that we talk a lot about to LPs, and how we've built an origination machine over those last 14 years. Europe is still very fragmented. It's still very local when it comes to credit. So you really need to be in those markets, know the nuances, know the jurisdictional risks. And then the other aspect really for us is that structuring expertise. You can create a great deal opportunity, but you do really need to have an understanding of how to best structure a transaction, and that discipline around structuring is what I think can give you an edge beyond maybe some of the other counterparties that perhaps you're up against in a particular deal.
Paul, same question.
If you're asking for people to invest in you, they're investing in a company, and so you need to think about that holistically. There's the product, which gets at what differentiates the investment process. There is how are you going to market it and spread the word. There is who are your people, and right now there's what's your tech. And particularly right now, the fund that I came from, Bridgewater, I think that one of the reasons they were able to do what's called systematic investing is from a very basic thing, was that Excel was invented in the 80s and allowed them to do that. If Excel hadn't been invented, they wouldn't. For us, it's AI has massively transformed how we do research and also how the world is changing. But you need to holistically understand those four things. The product, it involves not only great investment strategy, but a fantastic back office. Who are your partners? What is your resiliency? They are giving their money to an emerging manager. It's a risk, it's new. And so you need to give them assurance on all of those different categories that they've been well thought through, and we do that.
So let's stay with the idea of AI. How are you using this both in making your practice more productive, more efficient, and using it to identify market inefficiencies where there's alpha to be had. Stay with you, Paul.
It's changed the nature of everything we do, and it's changing the nature of all of our realities, as I'm sure everybody knows here. But in very practical terms, we both organize data systematically, but then we apply that understanding discretionarily. A third of the code we've written to organize, we're tracking the whole world, has been written by AI. And so things that I know from past businesses that I was a part of that would have taken teams of 20 or 30 people 6 months to do, you could literally do in 2 people in 2 weeks. It's unbelievable. And then it also relates to how you're filtering information. When I wake up in the morning, I used to read something, the banks will put out something in synthesis. Now I'm literally having a conversation with an AI agent. It goes into asset selection, et cetera, et cetera. So it's literally transforming the nature of the society we live in, the politics we're a part of, but definitely investment management.
How about you, Nadine? How is AI impacting your fund?
So I think the investment team very much are developing their use of it on a daily basis. And we've certainly been utilising Claude Co-work, which I think a number of investment managers that are certainly in our space are really utilising on a day-to-day basis in order to create better efficiency on reviewing transactions, looking at the detailed analysis, and even now creating first stage models. I think I'm told by the investment team it's getting better and better every day. I mean, in the context of my role as CEO, I don't like using AI for many reasons. When you think about the fact that what I'm trying to do is build proper relationships, human relationships, I think that's one thing that AI is never going to really be able to replace, or it certainly should be the very last thing that it ever does replace. Although one of my team did use it recently to decide which girl they were going to choose to date. I think from my perspective, I want that authentic voice, who I am, what I stand for, to be able to be shared with, our investor base. And so I think that's something that I try to sort of veer away from, albeit that, of course, it's very helpful from an efficiency perspective when you're creating documents that need to be produced as a first stage, just to get a boilerplate, it's helpful. But otherwise, I personally prefer to still, write myself.
So I don't know about Claude's dating advice, but before you meet somebody, you can do a deep dive into their background so quickly and efficiently.
Yeah.
Are you not using it for that?
I do.
Come on, admit it.
I do to some extent. I mean, I use more people. I use my network and I look at who someone actually knows, because Claude and AI is only going to give you sort of what's in the press. That's not going to tell you about them as a person. And if you really are trying to build a proper relationship with someone, it's obviously helpful to be able to walk into a room and know a bit about them. And the best people to tell you that are the people that they work with or somebody that knows them well. So my personal way of doing things is very much still on a, human level.
Michael, I know you guys are big AI embracers. Tell us how it's affected the fund.
Yeah, so it's almost like a where do I begin? And I think it follows along with the journey of our fund and just wanting to be metrics driven. And we started off using some Morgan Stanley fund data to determine how we were achieving hit rates around earnings. And then we wanted to take it a little step further, and we signed on a really phenomenal third-party risk system called Arcana, and started inputting data and really understanding, what the managers, what my investment team was doing and how we were lining up the portfolio and basically how we were balancing things. But it was still very manual to go in and to look and to understand. What I wound up doing over the last 7 months, and I would say tirelessly, was using a few of the different language models, and particularly Claude, as we found the most success with. We built a system that basically acts as a framework and a netting around our investment process. And to say that we've had success with it is an absolute understatement. The hit rate, at least for one quarter, when we've started implementing this around our process this quarter, has gone up astronomically. It has allowed us to identify when companies are seeing idiosyncratic moves the week ahead before maybe something major is coming out. It's picking up really, really unique and fine ticks in a company where maybe it's saying that something is all of a sudden over-earning. That prompts us to then look into, okay, what is the idiosyncratic move in the momentum of the stock? Okay, talk to our lead analyst in aerospace and defense and say, something's going on here with Boeing. There was just an uptick. What's going on? Well, a couple days later, it's announced that the CEO of Boeing is going to join Trump on the trip to China. So we look at these, and it forces us to just have much deeper conversations, and it's improving how we control risk. In fact, there's been a couple, it's been an AI bull market, but there's been a couple unwinds recently. We've measured our portfolio's performance recently against prior unwinds, tremendous improvement, and I mean tremendous. And we're also using this just to improve efficiency overall at the fund. So I think right now a lot of the data and what gets scraped and what gets measured is very heavily focused on backward looking and trying to train it to be a bit forward looking. But we've done things recently where we've plugged in our models, we've plugged in our Microsoft Teams chats so we can get a sense of if my metals and mining analyst is feeling a certain way about copper and or some of the other precious metals, is that aligning with some of the fundamental data that we are seeing going through Claude, coming through the Arcana system, and is that lining up with our future views? I'm excited for what we've built. I am very excited for what's ahead, and we've just also started using agentic models. And the token usage and power consumption that we're using is tremendous. So I think to look at this and say that there's still upside in these names is actually an understatement.
Really, really interesting. So I got a little ahead of myself talking about your AI process before I got to ask about the initial capital raise. Let's start with you, Nadine. What was it like raising money? Did you find yourself a seed investor? I know you did a lot of bootstrapping. Tell us a little bit about raising your initial dollars.
Sure. So we spoke a bit earlier, obviously, about the journey. The institutional capital, that was a slightly different journey, I guess, for us to have moved from retail to institutional. A lot of people are doing it the other way around. And in order to do that, I really had to look at over the last 10 years where European managers had really raised capital from for an opportunistic strategy like ours. And so having done that work, that really showed me that the US investor base seemed to really understand the type of strategy that we were going to be launching, and therefore it seemed, the right thing for me to do to come here and spend more time here and build relationships here. So we were actually fortunately backed by GCM Grosvenor in September last year with capital that also was then supported by 5 US pension plan institutions, which was fantastic for us to have as a launch pad. Because we're evergreen, of course, now I'm spending time trying to reach my hard cap on my funds. So I'm spending a lot of time on the road. And I really, it's back to that relationship point. I'm such a strong advocate for meeting people in person. I just genuinely don't think that there is anything that can replace sitting over a table with someone and having a proper conversation about the journey, the strategy, what you're trying to achieve. And that really does take a lot of effort. I mean, juggling family life. I have a 7 and 8 year old. I've been in the UK probably 8-9 weeks of this year, and that's it so far. It's a huge commitment of time, but it really works. When you bother to actually get up and meet people, they then really do start to believe in what you're trying to achieve in your strategy, and that goes a long way. So that's been my experience so far. And honestly, I had really no institutional relationships at all 18 months, 2 years ago. Having worked in the UK, having built a retail-led business, it was really alien to me to meet with institutions. I didn't really understand what they were looking for or how they like to talk. So it's been a huge learning curve. And a lot of how I've done that has been through attending conferences, networking opportunities. I mean, the GCM Grosvenor relationship actually was sprung from a female networking drinks in London. I met with a lady who worked for GCM Grosvenor there. She put me in touch with the US team, and that's how the relationship grew. So, you know, you make your own luck in life. You've got to show up. That's what I always say to people. You know, it's those moments in the evening where you've worked all day, you know you've got a drinks event to go to at 9 o'clock at night, or 8 o'clock, or whatever it is, and you really are tired and you don't want to go. You should go, you know, because you never know who you're going to meet, and you've got to just be willing to speak to anybody, and that might lead to something great, and that's certainly what has happened with us.
Really, Paul, I'm kind of fascinated by a 3-year garden leave. That seems like a really long time. What was that like? Were you feeling out investors then, or were you?
No, I initially left after 16 years with Bridgewater. I was talking about this with a colleague from Kate who's in the audience, literally gave away my business suits and said, that was a nice chapter in life. Wrote 3 books, started a blog, but continued to invest. And I'd been investing in this manner in a discretionary way, going and keeping records to 2007. It's just habit at this point. It's sort of like how I operate. I continue to do it. And at the end of the garden leave, I now had a lot of data about how this worked. And writing books was great. I know you've written as well. But it's isolating. And I really craved being with a team. And that process of the way I describe is having new fun. It reminds me actually of when I was a father the first time. Like the baby comes home and you're like, is it breathing? Is it pooping? Like, is it doing everything that the baby? It's like that type of attention. But the existential questions that you had in your life, if you had them, are zero at that point. It's like the baby needs to be fed, there needs to be shelter, family needs to be, like, very clear. For me, starting the fund was exactly like that. And so it felt very invigorating doing it. But it was that idea of, yes, the intellectual exploration that you got is writing, but then doing it in a team-based approach and trying to build something from scratch. I agree, it's a huge amount of, I've never worked this hard in my life, ever. But the motivation for me is just so strong.
Michael, what was your initial money-raising experience like?
I have to. I'm laughing a little hard because my wife and I very happily welcomed a daughter about seven days ago, and so quite recently. Yeah. Thank you. I like her. Nice.
And the emotion is similar to what I'm saying.
And I'm laughing because literally I was getting ready, and my wife's still recovering a bit. And I did that this morning. Like, yeah, exactly. I went over like 3 or 4 times just to make sure she's still breathing, which she is, so it's good.
Wake up at 3, see if the baby's breathing, and then you walk over, see where oil is trading, and you go back to sleep.
I think you don't understand how accurate that statement was. Yeah. But as far as the question was raising capital and what that was like, it's a bit funny because I really wanted to go out on my own, and there's always this debate of when the right time is. And you always, as someone that looks at equities and thinks about companies, and you always want to do more research and think deeper, there is a little bit of that trouble of like, when exactly do you pull the trigger? And it was someone that had been following me from my time at Zimmer that I sort of confided to and said, I'm looking to leave my prior firm, and really want to go out on my own, and what do you think about this? And that person, after 3 more calls, said, we want to give you capital. And I said, wow, this is really easy. And I thought, I was like, we're going to raise $1 billion. And then the incremental dollar after that was incredibly hard. And I think we've done a pretty good job. I try to be exceptionally transparent. We put deep dive research pieces out. We have a data room open that has sample portfolios. We're very communicative to investors about what we're doing. But I've told people that have asked me for advice on this, if you were ever the type of person that really was interested in somebody, a significant other, and they ghosted you, and you took that to heart, don't raise capital. Because I've had people tell me that I'm amazing, that I'm good looking, which I know they're lying about, and they've said, we really want to have a conversation. I won't name a firm, but there was a firm that followed up with me multiple times this past January and wanted to do calls. And we did a call. They said, this is exactly what we're looking for. This is honestly perfect, and we want to set up another call in 2 weeks. Haven't heard from them since. And they were the ones that reached out to me, right? So you have to have that thick skin. You have to be, persistent is, I think, an understatement. One whatever you think as far as what capital you're going to raise, it's always going to be less. Whatever you think the timeline is, it's always going to be more. But the one thing that I will say that maybe others haven't had this experience, when we spoke to the capital intro teams, there was always a number that they said it costs this much to run a hedge fund. And I think those numbers are about, to start and get something up proper is like 2.5 million to start a fund. Now, I think it's incredibly important that you have your entire net worth in your fund, in your business, to show alignment. I think it's also important that you invest heavily in the operational side of the business. But you can do those things and invest in the business and have an absolute world-class fund for much less than what those numbers are. And I think that is part of building a team that is aligned with you. It's building a team that you are giving equity to your team. You are understanding that the infrastructure that you have, you want something to fit your investor needs now, but you can always high grade if need be. And we've done that, right? We had a very basic risk system. We high graded to Arcana, which was fantastic. We had different types of fixed lines set up, and we were doing just allocations via mail and via email, and now we have firm lines set up. So I think it's been a journey, but I think you have to be persistent and stick with it.
I want to stay with the concept of not just raising money, but the operational side. When I launched my shop in 2013, I was shocked at how much time the business of running a business took as opposed to the business of managing assets took. Paul, tell us about your experience running the business side of it. What surprised you most about that?
Similar experience to you. So in the past, I'd done a lot of work on investing. I'd also done a lot of work in knowing how to communicate with people who were invested in the company. But Bridgewater was so large that there was a whole separate department that dealt with the implementation. I'd implemented my own portfolio for years, but it's totally different than implementing an institutional portfolio. So getting all that plumbing right, and sometimes, if you think about the old switchboard operators where it's people like plugging in things, like you'd be surprised at the actual guts of getting an institutional hedge fund. We use leverage in the fund, so we're, the market footprint of is bigger than $1 billion. You need to spend a lot of energy getting that right. One of the beautiful things about starting now is that you can get outside partners to help you. Where I'd been at before, everything was in-house. Now you can get outside partners that plug in, that are experts in that. We would not be where we are today if not for that partnership.
Nadine, similar experience?
Yeah, I mean, obviously where we've grown over those 14 years, our operations team has grown with us, but certainly through the process of raising the institutional fund, that required a different type of individual, I guess, in some of those back office roles. So a bit like you've just said, we've moved from a certain type of individual in the back office from a COO perspective to a much more senior person now who's leading as a COO on a day-to-day basis, is now part of the partnership in the firm. So we've had to, I guess, pinpoint individuals that we felt were going to help us scale to that next level. And I think that's always really, for me as owner, been the hardest thing to accept, is that sometimes, a bit like, I can refer to a Premier League football team. If you're in the Premiership, then you need a certain type of player. And sometimes if you've been in the Championship before the Premiership, the people that were with you in the Championship aren't necessarily always the people that take you into that Premier League spot to sustain you there. And that's a really tough gig for an owner and founder, to really look at your team and say, okay, have we got the right people and structure in place to allow us to now really take that next move and really scale? And so that's really the journey that we've been on over the last year, 18 months, is making sure that we've got the right people in place in order to help us scale. So adding head of fund accountings, adding a head of compliance, rather than having the outsourced routes that we perhaps previously had used. They've all been brilliant additions to the team, but it's the type of infrastructure that I think that the institutional investors are expecting when they look at you as a manager. Yes, of course, your strategy is one thing, your ability to invest and create returns, but really they have to be able to buy into your credibility as a business, the structure, the infrastructure of the business. And so you almost have to be, you know, when I speak to new emerging managers that haven't had a business like mine for 14 years, they're spinning out and they're setting up, I'm saying to them, you need to have that infrastructure almost and be a business before you can get investment. And that takes a lot of capital and a lot of commitment.
So we have time for one last question, and I'll start with Michael. There are a lot of people in this room who are thinking about going out on their own, either leaving where they are or doing a carve out or just launching a new fund from scratch. What's your best advice to next year's class of emerging hedge fund managers?
I think it's a really good question. I think what has been the most successful for us, or what's had the most impact, is maybe not what you would think. I think putting out research that discusses your views and being very transparent in your views and building those relationships on how you think about investing is incredibly important. That's I think number one, because that allows the investors to get to know you. You also, as I said earlier, have to have an extremely thick skin. You know, there are people that are going to tell you things and just outright lie to you about, you know, whether they're interested. I think it's also incredibly important to always build your fund as if you're going to be going to have double the capital, even though you might get half the capital that you're expecting. And that goes back to the operational question. I think that is incredibly, incredibly important. So I think those three things are what I would hit on.
Same question to you, Nadine.
I think, Michael, you covered quite a lot there, and they're all brilliantly helpful tips. I think the area that I would sort of focus on to add to that is the structuring of your vehicle. So where we're not a hedge fund, we're a private fund, we had the option of going to a closed-ended structure or an evergreen structure. And we went evergreen, which actually in the current environment is something that more and more people are doing, but it's still quite nascent for our particular space. And people ask me constantly, well, why did you take the evergreen route? Even though, you know, maybe that's going to require an education process for some of the investors coming in. And I said, well, that was the right structure for our strategy. Our strategy has a mixture of short-term nature and longer-term duration credit. So we'll do things that are sort of sub 24-month term loans. We want to be able to recycle capital and capture all of that deal flow in the market. And in order to do that, the evergreen structure was the right structure. So one of the things that people often ask me is, you know, do you kind of do what you think the LPs want, or do you do what's right for you? And I'd say, you know, stick with structures that suit the strategy. I think it's a really important piece of the puzzle when you're thinking about setting up a fund.
Good answer. Paul, bring us home.
Listen to yourself and decide if you're ready. It's not easy, but the big decisions that I took in life, I almost figured out years afterwards why I did them. I realized I was going to get married when I was 25 like that, and it was like, I'm ready, now I need to go. And I don't think I would have had the maturity or the confidence to do this when I was 25. Somehow I had the maturity and confidence to get married when I was 25, separate story. It's great marriage. But I needed to, I think it depends on what the person is like. I needed to work next to somebody else for years and watch both how they were doing it that I liked and what I would do differently. So I think it's very individual when you're actually ready to take the step, because it's a big step.
Thank you, guys. This has been tremendous. Let's hear it for this group.
Thank you.
We'll bring you out.